in the face of high inflation. If you're paying more at the grocery store and at the gas station, maybe you're not going to buy a new pair of sneakers or more athleisure. And you have to pair that knowledge with the fact that Nike's inventory was up 23% to $8.4 billion. A big reason being there are many goods stuck in transit. So Nike says it's going to do more discounting in order to work that inventory down. And that brings us to the margin point, John. As you said, flat to down 50 basis points, not the best news. And analysts really are looking at the fact that Nike says this direct-to-consumer business should help buffer margins. Some are more skeptical, including one over at BMO Capital Markets who cut his price target on the stock today. He's not the only one. And I would note that a lot of these headwinds analysts are talking about, China, supply chain issues, margin pressure, are not unique to Nike. They weigh over the consumer discretionary sector as a whole, which, like Nike, is down about 30% year-to-date, underperforming the broader market, John.
Some brutal numbers there. Kelly Lyons, thank you very much. I'll tell you someone who was absolutely brutal yesterday. It was Lisa Shallett. I go back home in the evening and I go over all the interviews again and make some notes. And I really wanted to bring you Lisa Shallett's comments all over again from this program yesterday. Take a listen to what Morgan Stanley's Lisa Shallett had to say.
Economists have begun to cut their top-down economic forecasts for GDP, and yet, fundamental company analysts are sitting there like deer in headlights, not knowing what to do with numbers.
Sitting there like deer in the headlights. That's not Crossmark's Bob Dole. He joins us right now. Bob, let's talk about that. Do you agree with that sentiment, that statement that Lisa Shallett of Morgan Stanley's made?
Look, I think analysts have undercut estimates now for several quarters, so I think they're reluctant, despite Lisa's good comment. The economic numbers are coming down, so they're setting themselves up to have to take some numbers down, but I think they'll probably, in many cases, wait until the quarters are released and see what guidance they get for the back part of the year. To defend corporate America, John, you know they've done a great job raising prices to keep up with cost pressures in labor and transportation and raw materials. The question is, how long will you and me and businesses pay those higher prices? And I think we're coming to the end of the rope. So I'm going to agree, earnings probably are vulnerable here.
So Bob, walk me through what that means for this market going through this summer and into the end of the year.
Well, I think it means it's going to be choppy. I don't think it has to go straight down. You know, we're in a period where perhaps good news is bad news and bad news is good news. Example, last week, growth was a little bit slower. Some signs maybe inflation's peaking, and the market likes it, takes off on the weak news. So if we get weak earnings, we may offset it by some pickup in PE ratios, which have gotten hammered so hard since the first of the year. So I think we're going to have a very choppy period. I do think short term, we're in our third bear market rally since this bear market started, and it's maybe only half over.
You're happy to call it that, though, Bob? This is a bear market rally, what we've seen over the last week.
I don't think we've seen the bottom, John. I want to see more capitulation. I want to see the VIX climb over 40. I want to see put-call ratios expand. And fundamentally, I would love to see some visibility on potential peak in inflation, peak in interest rates, and some visibility, we're not even close to this one, on the Fed getting the end of rate increases. That's what I'm looking for to get the final washout bottom. I think that's still in front of us.
And let's throw in this one as well, peak dollar. Do you think we've seen that, Bob? Because looking ahead to earnings season, it could be a key feature of earnings. It was for Nike, it will be for others. It's going to be for Microsoft. They've already talked about that. Are you willing to fade the dollar strength? And if you are, how do you capture that in this equity market?
Yeah, I am, although in all honesty, I've been calling that since the first of the year and been wrong. I think the fact that relative economic growth in the U.S. has been better, our Fed has come to the fore to raise rates faster than other central banks. That's given some resultant and latent strength in the dollar. But I think the dollar is overvalued. We're going to see some weakness. So that tells you got to be careful about how many multinationals you have in your portfolio, and make sure you have some non-U.S. The non-U.S. averages are down less than the U.S. so far this year, which has surprised a lot of people, John.
I get nervous, Bob, when a lot of people start coming on saying bad news could be good news, and I just sit here thinking, good news for what? One thing that's jumped out to me, Bob, and I'm sure it has to you, is the amount of people that talk about heightened recession risk, but then talk about a long in energy names through the rest of this year. I just wonder how much longer that can persist, Bob.
I think you're right, and of course we saw last week the energy stocks absolutely get, and the week before, underperforming significantly. And in some ways that's a good sign. Typically the last thing that gets hit are the strongest stocks. They got hit, although I think the energy story is not over. But you're right, energy, I like it, and recession in the same sentence are a little hard to fathom.
Bob, just a final one from me. If you had to sit in a pocket of this equity market through the rest of this year, with a degree of confidence, can you think of a part of this equity market that you'd like to do that with?
I want to do it in high quality. Earnings delivery, earnings predictability, balance sheet management. HMOs are a good place to play it. They've done better than the market, but that's a place I'd hide. We talked about the financials earlier. I like them too, but was not mentioned insurance. They're some of the safer places too, I think.
Hey, Bob, awesome, as always, to get your view on this program. Bob Dole of Crossmark, thank you, mate. Appreciate it. About 13 minutes in, we are positive by 1% on the S&P, on the Nasdaq by about 0.9%. Big week coming up for central bankers and global leaders. Up next, the US and its allies ramping up the pressure on Russia and China.
Our new concept will guide us in an era of strategic competition.
That conversation up next.
So for all those Republicans in Congress criticizing me today for high gas prices in America, are you now saying we were wrong to support Ukraine? Are you saying we were wrong to stand up to Putin? Are you saying that we would rather have lower gas prices in America than Putin's iron fist in Europe? I don't believe that.
Pretty strong words from the President of the United States, using the international stage to push back against those at home and abroad. G7 leaders now turning their attention to China, calling on Beijing to urge Russia to stop its military aggression and immediately and unconditionally withdraw its troops from Ukraine. This according to the text of a statement. Bloomberg's AMH Anne-Marie Tadeo join us now. Anne-Marie, before you depart Bavaria, talk me through what we've achieved in Germany at this G7 meeting.
Well, John, a lot of the stuff that was achieved in Germany is really just setting up the stage for more talks to continue. Of course, there's a lot of urging on a number of factors. That's for the unity, to maintain that unity amongst the G7 and its allies, to support Ukraine, to keep the pressure on President Putin, and then, as you mentioned, of course, to make sure they are steadfast when they are combating against China and urging China to lean more towards the West and stand up for Western values and not continue this support, even though sometimes it's behind the scenes, with President Putin. Most interesting, which really got a lot of the talk, of course, is this idea of an oil price cap and as well as a Russian gas cap in Europe. Daniel Flatley, our colleague, just wrote a great piece talking about how it's a Rubik's Cube, and the fact that it got into the text, that they want to even continue discussions, is a big deal. But for this to actually hit the market, it is going to take a number of laborious conversations with the private sector, insurance companies, shipping companies, as well as massive buyers, especially for crude, Beijing being one, New Delhi being the other, and then Russia, of course, being willing to sell that crude for the cap that Western allies decide on.
This is question number one for me, Maria. Just listening to everything that AMH has just gone through, how do you achieve that oil price cap that they're looking to talk about without including India and China? And at the same time, the president's going to go from Bavaria over to Madrid, and there's the potential for NATO to criticize China. At the same time, they need China on board to do something about Russia. Maria, can you square that one for us?
Well, it's a difficult one to square, but the focus, of course, as you say now here, is NATO. But the way they see it is that this is not about the oil cap. It's not about specific countries like India and potentially China on the oil. This is a much bigger conversation now about security and defense. And what they argue is that we're going to see the most sweeping changes to that security definition probably since the Cold War. So this is about the weapons and the politics. It's a different type of conversation to that in the G7. Jonathan, if I could say, well, in my view, the NATO this year is much more important than the G7 will be. We know that there's already indications from the NATO Secretary General Stoltenberg that allies will say that Russia is, quote, the most significant and direct threat to NATO security. This is not just Eastern Europe. It's now the entire alliance. Remember, they're bound by Article 5. If one country gets attacked, everyone will have to come to their defense. When it comes to China, to your point, they will now say openly that this is a systemic challenge to NATO. The language around it will be interesting. And then, of course, we always circle back to the perennial debate at NATO, and that is defense spending. What the NATO Secretary General now says, and what a change in tune here, is that the 2% of GDP is not the ceiling. It's going to be something that could be extended way beyond that. It's not the floor, it's the ceiling.
Stoltenberg also talking about the progress over Swedish and Finnish membership. Obviously, Turkey has some reservations about some of this, Maria. Walk me through the potential for this to happen anytime soon.
Well, Erdogan is the start of day one here. All eyes are on the Turkish leader. Of course, he says he has some concerns about Sweden and Finland. He says they don't fight enough counterterrorism and terrorist operations. Now, a lot of the critics say that this is just Erdogan trying, of course, to get concessions and time with the President of the United States. But I have to say today, Jonathan, the mood has really shifted from the morning to now. And there is optimism that a deal to include these two countries to NATO may be on the cards by the end of the summit.
Range of headlines from Stoltenberg also on China. Disappointed China won't condemn the Russian attack, but they don't regard China as an adversary. Anne-Marie, I want to leave you with the final word here. What would they describe China as?
Well, they're not going to say adversary, but they are going to say that China is strategically a hurdle, if you would. The exact text hasn't been completely defined yet, Jonathan, but they're getting there. A little bit more pressure on China. I would say it's a huge 180 from the last time we got this text from NATO. In 2010, China was not mentioned, but Russia was, and Russia was mentioned as a partner. And part of the reason why they will not go as hard as saying adversary on China is because the country I'm standing in right now, Germany, they have massive, among other European allies, have massive trade with China, economic ties, business ties, and they want to make sure they can balance these two struggles.
The weak link on two big geopolitical issues is Germany seemingly all over again for many people. AMH, wonderful coverage. I know you've got to catch a flight over to Madrid now alongside Maria Tadeo, and I just get this sneaky feeling I'm missing out on something this weekend in Madrid with the two of you.
Oh, you are.
Having a very good time. I'm aware. Maria Tadeo.
Never reveal private details, Jonathan, on camera.
I'm not revealing a thing, and neither are you apparently. Coming up, the Trading Diary, the market-moving events you need to be watching. That'll be next on this program. With your equity market shaping up as follows: a lift up 1% on the S&P, advancing 40 points, up 0.75% on the Nasdaq from New York City. This is Bloomberg. 25 minutes into the session in New York this morning. Good morning to you. Last week, energy stocks got absolutely hammered. Yesterday, they bounced back and they're climbing aggressively again this morning by 3.5% rather, so far, up 1% on the S&P. On the Nasdaq, up about 0.7% or so. That's the price action. Here's your Trading Diary. President Biden meeting with the Prime Minister of Spain in Madrid. That's coming up at the top of the hour. Plus, San Francisco Fed President Mary Daly speaking at 12:30 Eastern. Central bankers in focus. Wednesday, the big one. Powell, Lagarde, Bailey, all on one panel in Sintra, Portugal. Plus, look out for US GDP at 8:30 Eastern. Personal income and spending numbers and US jobless claims coming out on Thursday. And finally, rounding out the week with the big data point of the week. On either side of the Atlantic, you get ISM manufacturing numbers in the US. And over in Europe, you get Eurozone CPI on Friday too. From New York City, that does it from me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, June 28th. Here are the top market stories that we're following for you at this hour. It's turnaround Tuesday for now. Equities rally, yields rise after China cuts travel quarantine, what it means for inflation and for markets. And mulling oil price caps, the G7 debates capping prices on Russian oil sales, the latest attempt to calm the energy crisis as world leaders now head to Spain for a NATO summit. And Polestar downshifts to neutral. The EV maker stock is down almost 30%.
Confidence certainly taking a hit, but unsurprising given what's happening with gas prices, given what's happening with mortgage rates. We come through at 98, Alex, 0.7. 98.7. Now the prior number was 106.4, but that has now been revised down to 103.2. The survey number here was 100. Present situation's 147.1. The prior number there 149.6, and the expectations number drops to 66.4 from 77.5. These are and that prior number has been revised lower as well. Then you've got the Richmond Fed Manufacturing Index, which has come through at minus 19 from minus 9. The survey there was expected minus 7. These are not good data, to say the least. These are not good numbers. The consumer certainly appears to be rolling over fairly quickly. But that's just my take. Let's actually get an expert on what is happening here with these numbers. We're joined by Dana Peterson, Conference Board's chief economist. Dana, they don't look good to me. How do they look to you?
Well, certainly the data are starting to weaken. The overall measure ticked down again, and it's really not that surprising. Consumers are being buffeted by higher energy prices, higher food prices, higher rent and housing prices. They're also seeing interest rates rise, which means that it's much more difficult for them to finance things like cars and cell phones and purchase homes. So it's really not that surprising that confidence is continuing to tick lower.
Can we talk about the expectations for a second? Because it looks like on the expectation level, we're down to levels we haven't seen since 2013. Can you walk me through a little bit of what we learned from the expectation read?
Sure, absolutely. What the expectations numbers are telling us that consumers are potentially seeing a recession around the corner. Any number below 80 is a recession signal for the expectations gauge. Indeed, here at the Conference Board, we have downgraded our forecast for the U.S. economy. We do expect a brief but shallow recession starting in the fourth quarter of this year and then extending into the first quarter of next year. So what consumers are telling us are consistent with what economists are now expecting.
Dana, I hear what you're saying about the fact that in some ways this is unsurprising. The consumer is certainly being buffeted by a number of factors right now. But the rate of change is what really catches my eye. Are you surprised by the rate of change? The confidence numbers are decelerating very quickly here.
Well, certainly they are. I thought they would have come down even faster, but it's been really holding up, and that's because the present situation numbers are still pretty healthy. So right now, consumers are working. They're seeing wage increases. Some of them still have savings from stimulus checks. And so the income is still coming in, and they're able to weather the inflation that they're seeing. But that's certainly part of our headline. So that's keeping the number from falling dramatically. But still, that expectations gauge is worrying.
especially the median inflation expectation now sitting at 7.7% versus 6.8% the prior month. I wonder, Dana, how sticky do these numbers tend to be in that if we wind up having commodities, say, come off the highs, right? We have financial conditions are tightening, etc. How fast can we actually revert to the positive?
Well, I think it's going to be some time. Certainly our own inflation expectations in terms of forecasts, we still think that you could have a big number on inflation for June. We're hoping that the second quarter will be the maximum in terms of year-over-year inflation rates, but still inflation is going to take some time to come down. Even by the end of next year, we have the PCE deflator at 2.6, 2.7%, which is still above the 2% target. And that is including what we're anticipating are going to be many more interest rate hikes by the Fed and even raising the Fed funds rate to the range of 3.75 to 4% by early next year.
Just worth pointing out to our audience that we are seeing a little bit of a rollover when it comes to bond yields, i.e. prices are catching a bid. Certainly you're seeing that at the 2-year level and also the 10-year tenor over in the United States as we watch this number have an impact on the market. Dana, we've been much lower than this. During obviously the great financial crisis, the GFC, we were down in the 30s. How low do you think this number goes? You're talking about a mild recession. What is a mild recession commensurate with in terms of the headline numbers here, do you think?
Well, the thing is that you can't really match up the consumer confidence index against GDP. They just move very differently. So it's really a signal of confidence as opposed to forecasting GDP. But what we're thinking is, slight dips in GDP minus a couple of tenths of a percentage point in the fourth quarter, and then again minus a few tenths of a percentage point in the first quarter. So, and then some uptick in the unemployment rate, probably at around 3.7%. And that's actually material because we were thinking the unemployment rate was going to fall to 3% by the end of next year. So we're really coming from a position of strength. And so we think that, again, there will be a recession. It won't be anything close to what we saw to the pandemic or even as long as what we saw with the Great Recession.
I should point out that equity is also rolling over here. S&P still up by 0.5, but nonetheless well off the highs of the session. Dana, does the Fed look at data like this and say, I can't do all the hikes that I wanted to do? We're going to have to wind up stopping hiking or cutting earlier than we thought?
I don't think so. The Fed is looking at inflation, and there are three things around inflation the Fed's concerned about. The Fed is concerned about the actual inflation numbers. The Fed's also very concerned about expectations rising and becoming unanchored, and the Fed is very concerned about its credibility. And so I would imagine the Fed is going to continue on its track. The weakening in confidence is commensurate with what we're expecting in terms of growth and the fact that inflation is going to remain higher. I think the Fed will continue on its track.
Dana, final quick question for me. If gas prices came down significantly, say they came down $1, say we came down by that order of magnitude, 20% here, how big an impact would that have in terms of consumer confidence, do you think?
I think it certainly would help with inflation expectations because certainly one-year inflation expectations are very much tied to gasoline prices, but they're tied to food prices. And certainly until we have a resolution to the war in Ukraine and the effects that it's having on food and energy prices, as well as on metals and semiconductors and everything that semiconductors go into, we're probably going to see these upward supply side pressures on inflation. So I think consumers, $1 off, certainly I would love that as I fill up my gas tank, but still very high inflation that consumers are going to be facing over the course of this year and potentially into next year.
Yeah, and they go in waves, right? Like one thing all of a sudden gets more expensive and something else gets cheaper and then it switches. It's not predictable in that way too, what I've noticed. Dana, thanks a lot. Really appreciate it. Dana Peterson, the Conference Board Chief Economist. Thanks for joining us. All right, well, coming up, what does that mean for the markets and for companies? You have these rosy profit estimates, and that might mean more downside risk for stocks. That's what Goldman Sachs is saying. We're going to discuss that warning with Louise Gowdy-Wimmering of Crew Advisors coming up next. This is Bloomberg.
Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon. Plus Middlesex Fife and Drum and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
Moving on to some of their gains here, NASDAQ 100 now flipping into negative territory. Goldman Sachs out with a note warning that stocks could face more declines. And the bank strategists are looking at profit margins and say estimates are currently too optimistic and will likely decline next year whether or not the economy falls into recession. And then we get this really negative read on the consumer from the Consumer Conference Board. So joining us now with her outlook is Louise Gowdy-Wilmering, partner at Crew Advisors, an independent advisory firm. Louise, when you put it all together, right, you get the profit margins on the inflation front, and then you have potential top line getting kind of crimped by weakening consumer demand. What is your outlook for the rest of the year?
Well, I think that is certainly a possibility, and I think a lot of this is going to hinge on price performance as we see the second quarter earnings come in, which is one of the reasons that I think that it's really important to pay attention to where the stability in the market lies. What we've seen is, looking back this year, the areas that have done the best really have been healthcare and staples, which are the areas that were sort of left for dead as everybody was banking on future growth going forward. But the stability has been in those lower PE stocks, or the more stable PE stocks, I should say, such as the healthcare and the staples. It'll be interesting to see how second quarter earnings come in. I'm not sure that the market has really priced that in, the margin compression yet, which is one of the reasons when I've been looking at things, I've been looking at trailing 12 PEs rather than forward, because I'm not sure that earnings have fully adjusted for what earnings might be in the second quarter.
Louise, stability is an interesting word to use. This market, the world, the macro backdrop feels anything but stable right now. What's your degree of certainty 1 month out, 6 months out? How easy is it to make investment decisions right now?
Well, I think you have to make long-term choices. I think that it's a relative stability. Our clients are looking for the diversification and where the stability lies in the current market in order to stay invested. And that's why those areas have hung in there. As you look at second quarter earnings coming in, there might be more opportunity if there is some fluctuation in where earnings come in to go into those areas that have been the most beat up in 2022. Maybe there'll be a better entry point for some of the technology. At this point, I'm not sure that we can tell that yet. So I think looking for the areas of relative stability have been the way to play the 2022 market.
Well, I also feel like in order to know that, don't you need to kind of know which the bigger risk is, inflation or recession? It was inflation, then it tilted to a recession very quickly. What do you think? What's the bigger risk for the equity market?
Well, I think they're all intertwined. Certainly, interest rates were coming off a zero level in the pandemic, and we've seen huge increases in where the level of rates are. If you look at, we started this year with the 2-year at like 135, and now we're at 308. So those have been huge increases. Everything else is the 5, the 10, and the 30 are all priced in the 3s. So I think that there is some risk, certainly with interest rates. But no matter how much the Fed raises interest rates, that doesn't change how much oil is going to be produced and refined and distributed. But it will certainly dampen the housing market, and we're starting to see that now. So I think the biggest risk is how quickly and how steep the interest rate curve becomes, because that will have more of an indicator effect of what earnings are going to do.
Louise, a lot of what I'm hearing about at the moment is centered not on kind of what happens over the next 6-12 months, i.e. the Fed's hiking cycle, People are now trying to figure out what the Fed's cutting cycle looks like and getting ready to position for that. How nimble are investors going to have to be over the next 12, 18 months as we go through what looks like an accelerated cycle? We see the Fed stepping on the brakes pretty hard, and then when we start to see maybe inflation becoming a little bit more tame, maybe starting to trend in the right direction, the Fed quickly flips to cutting. How do investors navigate that process?
Well, that's the trick. I think we need to look at what we anticipate for coming through the year. I think the Fed has to overshoot in order to get to the level of inflation that they're aiming for. But once again, if we see some of these supply shocks abate, if we have any real resolution in Ukraine, I don't know that we'll see continued 75 basis point hikes. However, I think we've become accustomed to seeing interest rates come down as soon as the market gets a little panicked. I don't know that they'll cut interest rates as swiftly as they raised them. So I think we're going to be in a world of somewhat higher rates for the next year and a half or so.
I just want to wrap in some of the news of the day, and that came out of China. Many were attributing the rally that we see in the equity market today to China loosening their quarantine rules. When I saw that, my first thing was, oh no, that's the last thing we need, is actually more buying and more demand coming from China, adding to an inflationary impulse. And a question from a viewer asks how you see it. Is it good for the growth story, or is it negative for the inflationary story?
I think overall, in order to get a good lens on what the economy is doing, we need to have China as a significant contributor opening. Certainly that will put pressure on oil and some things, but it should also maybe get some of the supply shock problems out of the system. So I think it will provide some normalization so we can see where we're going.
Final quick question from me, Louise. You spoke a moment ago about your investors' desire to stay invested. Why is staying invested the right call right now?
Certainly what we've seen in prior bear sort of markets is there are huge rallies that can be missed. And certainly we hope to see higher lows and higher highs as we move forward. But it's very difficult to anticipate when things will end. If there was any sort of resolution in Ukraine, as China comes back on, I think it's important to remain invested and diversified and keep a longer term view because it's really easy to miss some of the biggest days.
Louise, it's been great to catch up, really informative. Thank you very much indeed. Louise Gowdy-Wilmering of Crew Advisors. Thank you very much indeed. Bit of breaking news coming across the Bloomberg right now. Citadel's global head of BizDev is leading basically to head the joint venture the firm is now building, designed effectively to increase access for investors to cryptocurrencies. We'll deal with the details of that story next. This is Bloomberg.
This is Bloomberg.
Get back to that breaking news. The global head of business development of Citadel is leaving to run a crypto venture. Bloomberg's Shanali Basak joins us now with this story. Shanali, what can you tell us about this?
Yeah, it's a great scoop broken by Catherine Doherty here of Citadel Securities, that massive market maker we always talk about in relation to Robinhood and other things that really help democratize stock trading here and make it cheaper for retail investors to trade. Now think about that movement moving over into cryptocurrencies. Jamil Nasralli was the business development head at Citadel Securities, now moving over into a crypto venture that is also has the support of a lot of financial heavyweights like Virtu. And the question here, Alex, is this massive convergence you're seeing between TradeFi and DeFi. And it's very similar to that, what you're seeing over at FTX and Robinhood, that big convergence you're seeing between traditional crypto players who want to get into stocks.
Okay, let's just talk about that deal then, Shanali. Do you think they're going to go ahead with it? Where are we in this process? What kind of a timeline are we hearing? There hasn't been a formal offer made yet by FTX. Is the expectation from the people you're speaking to that that is going to happen?
The wanderlust is real. It's very interesting to see this happen because you look at Sam Bankman-Fried and you look at two different companies. You look at a company that's grown very conservatively with a not explosive headcount like its brokerage peers, but then you look at Robinhood that has had hyper growth over a number of years, yet that market cap has come down so much. You have to wonder whether it makes sense. Remember, Sam Bankman-Fried has come out and says that there are no active discussions. But with that said, FTX's desire to push into not just crypto assets, but traditional stock trading and futures and options can get really interesting really fast. And does the question being, does the Robinhood brand give them anything they don't already have? They are, as we were discussing, thinking of really making big changes in the way that stock trading even works in terms of market structure. They have a stake in IEX as well, Guy. So a lot is happening between all of the market makers in this world right now.
Okay, since we have you here, let's talk about some of the big Wall Street banks for a second. We had a scoop here on the Bloomberg that Goldman Sachs and their markets division, that consumer push, is actually losing that money. We were talking about it in break. What do we know about how they're losing money in this?
It's really interesting because you do see Goldman Sachs really expanding markets significantly, 13 million customers, $100 billion worth of deposits. But yes, as Sridhar Natarajan broke today, it is losing more money than initially expected. So what analysts and investors are looking for is for this Goldman business to really turn the corner here. But remember, double-edged sword. It is expensive to get into the lending business. A lot of the big consumer banks also are facing a tougher macroeconomic environment ahead, but it does also lower the cost of funding for Goldman Sachs. So are they going to make this big strategic pivot in the way that we've seen other banks, for example, Morgan Stanley, have done in the past? Though Morgan Stanley's consumer division leans more